All right, good afternoon there, everybody. This is event trader Gavin McGuire, about to be joined by chart trader Brett Manning. Brett, you there with us?
Sure am, Gav. How you doing?
Not as good as you with your fancy Nasdaq short there, banking some nice profits.
Wasn't it?
It was pretty fancy. Something happened with your mic there, Brett. You went a little
What's that?
quiet.
Am I quiet?
You sound okay. If anybody else is having issues hearing Brett, you sound a little bit better now. So something
Okay.
went on there. Maybe you just had the microphone pulled away for a second, but sounding loud and clear. But why don't a lot of people are asking about that Nasdaq trade. So why don't you walk us through what you were seeing? I guess we could start off with that 5 a.m. Headline out of China that kind of got everything rolling on the upside here, and what you were looking at and how you were stalking it for that short.
Well, I mean, it started yesterday for me in terms of looking for a headline-driven bounce to potentially roll over in an environment where we see a lot of other negatives, and we haven't really been sitting in a tremendous kind of bear sentiment extreme, and we'll talk more about that. I think this is a two-way tape. And I think that there are some longer-term issues that maybe put some pressure on things. Type specimen bear pattern setup would be a headline-driven bounce. You find a point to fade it. I tried a couple times yesterday, and I was fortunate enough to be wrong and still make money. And I thought that there was a chance the same thing would happen this morning. I'm seeing this market well in terms of shorter-term setups, and then I've got the bias of looking for a retest of the lows and maybe a breakthrough the lows that we've seen over the last couple months. So I really was just kind of looking to place a position there. And this morning, I commented early on that the put call started off really, really low, which suggests that you've started to see people really kind of get out of those hedges. And, of course, the only way back into them is to sell. So it puts you in a position where the market's leaning, perhaps because of the headlines, perhaps because of some of the analyst coverage that we've seen over the last couple of days, that we might be pushing into some kind of rhetorical or political solution, or at least some kind of taking the pressure off with the Fed still in place. So there was an environment that led me to believe we could have a gap up reversal today. And after I saw the put call number, the short-term pattern set up, and it just made sense to move into it. Similar to yesterday, quick scalp at the inside target, quick stops to the break-even level, just basically allowing myself to rinse and repeat a process where I'm exposed for a bigger move, but I'm not really putting myself in a position to take any major cuts trying to get into it.
Yeah, no, brilliantly played for sure. And like you said, even the two you took yesterday, while not as nice as this one, were still profitable. And
They were profitable.
that's the key. I mean, even if you're not profitable, but really manage your risks and your losses so that when you do hit one like this, it's just a little bit of exponential growth for you there on the pocketbook, which is always nice, right?
Very much so.
So, okay, so let's take a look at some of the sentiment and flow data that we've been seeing. I guess first thing that we could talk about is, maybe some of our thoughts on Jackson Hole and the G7 in general, because, obviously that event's gone off since we've talked last, and we just want to kind of get a recap of your thoughts on that.
Yeah, sure. I mean, I thought that Jackson Hole was a placeholder job, basically. The event actually happened. Powell did give a keynote speech, but no work was done, so to speak. There was the acknowledgement in his speech that we are in a new regime where, we've got the way that he framed it was in terms of R star, or the neutral rate, being exceptionally low and persistently low, and that constrains people from being able to take particularly meaningful monetary policy action. But he didn't really get to the point where he started to explore the idea of we need completely new solutions. There needs to be revolutionary thinking in terms of monetary policy solutions. He didn't really go there, just kind of addressed the fact that we live in a different era for monetary policy that's particularly difficult and constrained. So Jackson Hole was really a non-event, I think, for the market. But it really didn't matter, because in terms of the market's perception of the news cycle, it was so completely drowned out by Trump versus Xi on Friday that it really doesn't matter. And then I thought that the G7 was a public relations move essentially for the administration to make sure that people realize that it's not being intentionally divisive. It was basically just
Sure.
kind of trying to send out some good vibes. Hey, we're totally for unity and constructive working together, coordination, and everybody kumbaya. And that was really just a tonal kind of move, I think, really, just to allow the continued more divisive types of strategies that are being implemented.
Right, and they obviously decided to try to strike up with some of the allies there, reaching deals in principle with, it sounded like, with France and Japan, and
Maybe, yeah.
and holding off on any auto tariffs until December at least anyway. So
But I think I think those moves are really just it's about, well, we got to make sure that it doesn't look like we're just being isolationist and protectionist, so that we can continue to put the heat on China, which may be a right strategy. I'm not necessarily saying it's not. I think that it was, rather than maybe being what it seems at face value, that it's a coordinated part of a larger strategy.
right, so basically you thought it was a lot of fluff and not a lot of substance, basically.
Well, I mean, I don't know. Maybe it is substance. I mean, I don't know. I'm not going to evaluate that. I think that there's a coordinated strategy to maintain the process that's happening with China, and really avoid the perception that it's isolationism.
All right, and then probably the other big economic event since we last talked, Brett, was the PMI numbers. So breaking into a little bit of the economic sentiment there, certainly running light across the board. The U.S. the most notable, with that manufacturing number slipping ever so slightly into the contraction area at 49.9. Some of the things that they talked about in the PMI data was they noted the renewed slowdown in the rate of U.S. private sector business activity growth. They also talked about the slowest pace of expansion for 3 months, and the latest reading was the joint lowest since February of 2016. A lot of it just being pointed to business uncertainty and corporate spending slowing down in response to softer business conditions and concerns about the global economy. Also talked about job creation easing to the weakest since February of 2010. It's obviously not no numbers that President Trump really wants to see under his watch, I would say. But did you have any takeaways from the PMI numbers from the U.S. and then I guess the rest of the world too?
No, I mean, it's the same drama, especially when you hereby order companies to do things. It's not the type of environment where people are going to feel like they necessarily have control
and that would have been after.
I know.
All this data would have been before that order on Twitter.
Right. But it's a symbolic, characterizing, archetypalizing kind of event. This is the environment you're living in if you're running a business with a global supply chain. How much are you really going to feel like, well, let's really start to invest. Let's open up this. Let's make long-term commitments of capital. None. So you don't know what's coming a week from now or 2 weeks from now. And, whether you judge that as a good thing or a bad thing, I think of it like chemotherapy, at least from the most optimistic view. I think of it like there's the perception by China hawks, and whether they're right or wrong, and I assume that there seems to be bipartisan agreement that to some extent that it is a correct way to look at the situation, that something needs to be done about China, so to speak. And so let's look at that as the tumor, and you can look at what's happening to business investment and spending as kind of like the symptoms that are associated with chemotherapy and radiation treatment. And to suggest that there's no problems there is ridiculous. And the question is, we don't exactly have FDA studies on this type of thing. How much is this going to turn into a negative and spiraling feedback loop? Because when you start to cut, I mean, the economy is like an ecosystem. It's like if you're looking at a rainforest, and you start to limit the growth of a certain kind of mushroom, all of the deciduous trees might start dying 2 weeks later. Like, there's really complex interconnections, and when you dampen something as big and profoundly important as business confidence and business investment and business spending for a period of months and months and months. And now I think that that's probably going to be diving further because we were escalating the situation. I think we've really kind of rounded that corner. To anybody who was holding out the notion that this is a trade skirmish rather than a full-blown trade war, I think at this point you need to admit that it's a full-blown trade war presently. And it's likely that we're not going to suddenly start to see, a ramp up in business investment and spending as long as this is going on. And from what I can tell, there's no signs that either side is about to capitulate. So you start to see the follow-on consequences. It's not just reduced business investment anymore. Suddenly you start to see the ramifications of that for a prolonged period. And I think that we're starting to see that actively, and the PMIs would be a sort of frontline view of that.
PMI is a frontline view, and I think where it's going to be most impacted is the Q3 earnings season coming up, because we've heard a lot of talk about the second half's going to be great, the money's there, people are just waiting for some direction, and that certainly hasn't come. And like you're saying, I mean, a lot of these, especially in the industrials, these aren't orders that you could just flip a switch and turn back on.
Right.
So that's really starting to play out. Here's an interesting piece I'll throw out to you, Brett. S&P Cap IQ had a nice rundown of the trade wars going on, a little webcast that I was listening to, and in it they ran a survey where they allowed people to click on 4 different things on when they thought the trade war would extend to. I'm just curious as to your take on these results. Before September ended, end of the year, obviously end of 2019, before the 2020 elections, and after 2020, what would your vote have been?
Right?
Out of your,
the last category is sort of never.
Yeah, basically. So what would your, because this plays into this little sentiment discussion we're having on trade right now, what would be your box that you would have checked?
So I would check after the 2020 elections.
Well, you would be in the majority. That's what I checked too.
Really? Who are the respondents?
Hold on, wait till you get these numbers too. And I see Carmine. He was listening to it as well. He had checked after 2020 as well. So that's all 3 of us here. 64% of people had checked after 2020. Then the next closest number was 27%. Take a guess at which one that was. If you need the 3 selections again, it was before the elections, end of 2019, and before September 3rd, or before the end of September.
Well, I mean, it would be, the next longest time.
Yeah, exactly, 27%. So right there, you have 91%.
But who are the respondents?
Me. What else do you need to
know?
No.
I thought you said this was a Capital IQ survey.
S&P Cap IQ ran a webinar. I didn't see the numbers on the total numbers.
No, but I mean, it must be like, what is it, investment professionals, the general public, economists?
No breakdown on the people watching it. So I mean, from that perspective, yeah, but it still gives.
But who's going to watch that webinar? Probably investment professionals.
Probably. I mean, I don't think that the average retail guy is sitting there jumping on that and checking that. So I would think that analysts and professionals that use the service. So I would say it's a qualified sample.
Yeah,
so 27% was before the election. So that means 91% of the participants didn't think that this trade war would end before within the next year, basically, right?
Well, by year end, I thought, wasn't it the end of this year was?
No, end of this year only got 6% of the votes.
And then before September,
before the end of September, got 3% of the votes. Some real.
Right, so 91% are saying, 91% are saying it's at least into next year.
Yes, the 91% saying at least into the end of next year, basically.
Well, I thought if it happened on January 1st. 2020, it would be in that third category.
I guess so. I suppose you could say that, but
Let me expound on why I would answer after 2020. There's a very particular reason. It's not just because it looks like nothing's getting done. The theory that I put forth with Jim about 3 months ago is when I started to adopt this view, and the view is that people have become too educated about precisely what would constitute a successful deal. if the White House had decided to come up with a face-saving deal a year ago, they could have gotten away with it. They could have gotten away with a big trade deficit reducing soybean purchase kind of contract.
And a huge PR push about how it was the greatest deal of all time, basically,
Yeah,
right?
they could have gotten away with that then. But now I think very much even the general public, what the cable news watching, no further researching general public understands that this has to do with things like the way that China's stealing our intellectual property and et cetera, et cetera, et cetera. And so I think that it's now become impossible for the White House to do a face-saving deal without it being publicly recognized by even Trump's core base, understanding that he basically gave in without being able to win the negotiation. And I think because of that, it would be more in this administration's benefit to actually campaign on the being tough on China matter, which is where you get to an inflection point where you're either going to make a deal to make a deal and campaign on we got a deal and we won the China thing, or you're going to campaign on if you don't keep me in the White House, China's going to keep taking advantage of us for decades to come. It's those two choices. And because of the level of education that's gone into this process, because of how long it's lingered on, because of how much press there's been, how much media there's been about really the intricacies of this situation, I think that it's in no way China's going to agree before we get to that threshold, maybe around February, March of next year is kind of that threshold. There's no way China's going to agree before then to really give the White House the type of deal it would need at this point, given how knowledgeable the public has become. So I think it makes it almost impossible for this to be wrapped up before the election.
Yeah, no, I'd agree with all that there, but I just found it was pretty interesting that much. But again, I suppose at the same time, too, that kind of runs to the risk of something getting done, right? Upside risk, obviously.
Yeah, sure. You're right. If everybody believes this, particularly investment professionals, that there's no chance of a deal, and then a deal is announced, then you've got a whole lot of people who are not positioned correctly.
And let me throw this out. What do you think? Do you think that the Trump administration is looking at, they don't necessarily, what do you think is more important, for them to make it look like they had China cowtail to the table and they beat them down into a deal that's going to make everybody filthy rich in the U.S., or do you think that they're just going to be better off with a good economy and a decent, or any sort of deal that they could try to turn around and say, look at this great deal we got from China. No other president ever had the guts to try such a deal, and just watch the market really rally aggressively. Do you think they could pivot like that? Because I'd say it's certainly possible.
I think that the narrative that Trump has, now he could shift the narrative. He's been good at totally working one narrative and then deciding suddenly to shift the narrative and then saying that other narrative was crazy. This is the main narrative now, and in ways that just make your head spin. You can't believe that he would develop such a strong, invested narrative in a particular kind of set of concepts and then just pivot, on a one day, and it's all something completely different. And that's, I guess, one of his strengths as a populist politician. But the idea has been, as I understand it, that really his base is consolidated around the idea that there's this Davos man. There's the elites, the global elites. There's the Wall Streeters. There's the globalists, etc., who have all kind of been bilking the United States for decades by setting up cheap supply chains outside of the United States and then ramping up the price of assets. And now probably, according to that narrative, they're in cahoots with the Fed in some deep state relationship or something. And, that worrying about what the stock market is at is the way that you side with the elitists and the globalists and Davos man at the expense of the everyday hardworking blue-collar American. I mean, that's been the narrative. And that's why he's taken on China. Even if it means the stock market goes down a little bit, we got to set right this thing that's been so wrong for so long and has been wronging all these people. And, that's what he's stood for as a populist politician. And it seems to be that's the outline of his kind of campaign narrative. And it would fit well with keeping the tariffs on, saying that we're actually making money from them and storming right through the election that way and trying to make sure that people feel like if they vote for someone else, they'll just be voting someone else in who's just going to go back to the old thing of the elites subjugating the proletariat and bilking them dry. And, it seems like if he were to do what you're suggesting, get a face-saving deal, ramp the market up, it really I don't know how people are going to hold him to that prior narrative, but it really would be, a striking kind of pivot there. So I feel like he'd need to get the kind of deal that he can say, and I do think if you wanted to just get a better trade relationship with China, you would have done this in a multilateral way, and you would have done it behind closed doors to give Chinese officials the ability to spin it to their own domestic markets.
Yeah.
Spin it as a good deal for them too, even if it's wrong. You get into a room with Xi Jinping and all his folks from all the bureaucrats, get around and say, look, here's going to be the way that this is going to go. But we're not going to say we crushed you in this negotiation. Find a way to message it so that you guys did a great job and forced us into what is really a compromise on both sides, to message it that way. But keep it behind closed doors and don't publicly shame people and take it out on Twitter every other day because, the way this has been going, it looks like they want to make it look like they're peeing on China,
Right,
publicly,
yeah.
rather than actually just trying to get a good trade deal. So now they've turned it into something that's a reputational risk to take anything other than, a hawkish line against the United States and to use domestic propaganda to try to make us look like the evil empire. And what really worries me about that is you've got literally hundreds of millions of kids in China growing up basically forming that opinion of the United States. And they're going to be, potential soldiers in 15 years.
Yeah.
That's an unfortunate side effect that I don't think people have given enough thought to.
Yeah, no, I mean that's kind of always where I've thought that this is going. We've talked about it in the past. So, I mean, and I think that's part of the problem. This whole FT story this morning, talking about how the Chinese hawks just don't trust the administration enough to make a deal. And I mean, certainly we've seen plenty of action, and we know from Trump's style that he's going to be braggadocious about whatever it is, and that just really makes the deal that much tougher, I think, for this administration to check. So again, that 2020 time frame certainly looks like something that is a best case scenario, really.
And just to reinforce the idea, this conversation is very much relevant to market analysis.
Yeah.
You cannot understand the future course of markets if you don't at least do a little bit of game theory analysis on the politics of this negotiation. So for anybody who's listening who would prefer us to stay away from politics, if we're doing market analysis at this point, there's no way to disentangle those concepts anymore, unfortunately.
Yeah. I mean, this isn't discussing whether or not a policy is good or bad. This is simply will they be able to achieve a deal? And you've got to look at all the different elements that are involved here.
Right.
So, okay, so with that, let's take a look at. I'm just making sure. If anybody else is having issues with audio, please let me know. I know there was one question about an issue on audio, so please let us know if you're having any problems. But let's go into the sentiment readings here then, Brett. We talked a lot about the sentiment in the PMI and around the trade war, and let's see how it's reflected in the traders' actions here. Now, if we're taking a look, there was a few there's a little bit, there wasn't a big change in a lot of the readings, but there were some notable ones here, and they were going more towards the pessimistic side, but not a ton of extreme pessimism, I'd say, but risk appetite was one that was sticking out to me. We were near extreme optimism on July 26th, but this has pulled back just a little bit. So do you have any thoughts on that risk appetite reading that we were looking at?
Yeah, not really. I mean, again, this is so much kind of filled in with macro risk index kind of issues. I mean, when you see the yield curve where it is, you know that you're going to see this kind of reading from something like that, and
right.
Gold. You've got market indications of a tremendous amount of caution among investors. This does not look like the late 1990s in terms of, it's just not that kind of market. But as we talked about last time, this is kind of like using money flows in terms of bonds and stocks over the last 6 months as a trading signal, and that's awfully tough to do because something has to break that process. We've seen this continued flight into fixed income and sovereign fixed income and right up the curve for most of this year. And for that to become a positive equity market signal, you need a regime change in terms of the risks and the growth potential in equities.
Right. So one of the other
So I don't see it as a particularly meaningful data point right now to see the risk appetite where it is, because I know that that's probably driven by performance in gold, performance in bonds, etc.
Okay, would you view the same thing for the inverse ETF, which isn't at the extreme pessimism side, but certainly was marching higher there? We'll get into some of the Friday flows that we're seeing, but I saw one story out there. Where was it? Let me see if I could just find the data point because I was going to ask you. Okay, for the inverse ETFs, this accounted for 1.2% of the total New York Stock Exchange volume on Friday, which was one of the largest amounts in history. Some of the other times were triggered last October or December. Now, when you go into history, obviously, inverse ETFs haven't been around for the entire time. I guess it would be dating about 15 years or so.
Pretty much.
We're looking for a historical process on inverse ETFs, but still an impressive amount of the flow on Friday, and I don't know if that would have
Yep,
been shown in the sentiment option
it is.
ETF. Yeah, 826. Okay, so that does take that in. Obviously, that jumped us right just short of extreme pessimism, but obviously marching that way. Do you have any thoughts on that inverse ETF volume that we're seeing, particularly last Friday?
Yeah, no, I mean it's. I think when you see the type of headline flow that we saw, I think you've got a lot of folks who really, don't have access to shorting instruments. There's a lot of money that's tied up in things. Different types of IRAs allow you to trade actively but not short. And I think that when you get headline flow like that and everybody wants to find either some way to hedge or some way to profit from the downside, I think you start to get these increasingly, you see these spikes in inverse ETF volume. And yeah, I mean, what I would look at this indicator as something where if that sort of attitude sticks around and continues even into rallies, then I see it as a squeeze indicator, right? When people are skeptical, not just in reaction to the headlines for an hour or two, but when it persists over the course of a few weeks, and people are even starting to mount this sort of thing into rallies, then I think it's particularly possible for that to end up resulting in a squeeze. So right now I see it kind of, just an example of the type of volatility that we're seeing back and forth through the range. But I don't see it necessarily as a big positive unless we see it persist. This market moves sideways for a week or two, and we maintain that sense of a lot of interest in inverse ETFs over that period. Then I start to look at it as, this is a real problem to be short this market.
All right, and two other items that were starting to move more into the pessimistic realm, but really, for the most part, just still kind of middling to all things considered. The SPY liquidity, which I know you like to follow a lot, and the VIX term structure. VIX term structure obviously has a little bit more moving parts that makes that tougher to read, but that SPY liquidity, I would look at it as kind of an inverse of the inverse ETF volume. Would that be fair?
That's I mean, you've got right. So you've got the fact that people are, especially stock pickers, are unwilling to trade actively in individual equities to a great extent. And that's lingering, and that is an important signal. As far as the VIX term structure, we do have a lot of volatility events that are stretching out a month or two or three from now. You got Brexit coming up, things like that. So we might see it being a little tougher for the VIX term structure to give a good backwardation signal, even when it otherwise might, because we've got particular contract relationships that are further up the curve where people are probably already setting a position for big portfolios to be hedged against a giant uptick in volatility. So, and I guess Brexit would be an obvious one there. So fixed term structure is a little bit disabled right now given future events. But to be honest, I guess I'm saying that because I would think that it would be possibly more backwardated. The type of volatility that we saw on Friday and the type of catalyst for it would usually, I think, spike that thing up to see increased risk of a near-term giant spike in volatility relative to a normal path looking forward. So I think it may be sort of tempered by the elevated 3-month outlook for volatility. SPY liquidity premium, though, continues to be an important indication that people are generally risk averse in terms of liquidity, that it's tough to get in and out of this market because something might come along at any moment and really floor the stock market. And an increased apprehensiveness about that sort of thing is usually the type of thing you see when the market has upside in front of it. However, it is also late August, so it may be that there's idiosyncratic reasons why that indicator is maybe not perfect right now either. If there's a lot of activity right now, people want to be involved in the markets, but they believe that the possibility of liquidity being a problem for short-term trading might be elevated because this time of year tends to be a time of year where we see illiquid markets. You have a lot of people on vacation, that sort of thing. It might be leading to an increased reliance on big ETFs. So those may both be kind of slightly reduced in terms of importance on circumstantial grounds.
All right, and then this one I want you to explain to the subs and to me too, actually. The bear market probability model, because I was trying to make heads or tails on this. I know you have this on your list of your favorites. And just for anybody wondering, this is a model outlined by Goldman Sachs, and they use 5 fundamental inputs: the U.S. unemployment rate, the ISM manufacturing index, the yield curve, inflation rate, and the P/E ratio. So the higher the reading, the higher the probability of a bear market in the months ahead. However, I've been seeing this coming down since late August. Late August was at about 0.8, got down to about 0.63 in June, and sorry, that's August 2018 I was looking at. But so this it's a couple weeks old, but it only stands at 0.65, which is viewed as an excessive optimism reading here. How do you look at this and how do you break this down? I know it's a little bit of a dated number, but I was curious to hear what you thought of this and what you expect to see in August.
Well, so I mean, I put this in there and I watched it just because I'm kind of intrigued by it. But I think that this is probably, an example of data mining in practice where people took, at Goldman Sachs took, 30, 40, 50 years of data on indicators where they could easily get that. And then they just basically raised it through some kind of process of, a historical best fit algorithmic analysis until they got to something that said, hey, when all of these things are like this, that's preceded every single bear market, and therefore we should assume that when all these things are like this, that it should be, we should be on heightened alert for a possible bear market. And if you look at some of the components, I mean, obviously in the past, a high inflation rate would be something you'd be worried about if you go back, if you're talking about the last several decades. But when they're very basic ideas. If you were to see a very high PE ratio with a high inflation rate, and you start to see problems in manufacturing, and the yield curve starts to signal some issues, and the unemployment rate starts to go up, that's probably a bad situation. And to the extent that all of those things are like that, is probably a bad situation. Right now, we've got a weird sort of environment because the inflation rate is extremely low. The Fed is already starting to ease, and we probably don't have, because earnings really weren't that bad over the last couple of quarters, we probably don't have something that looks like a historically extreme PE ratio issue, and the unemployment rate is extraordinarily low. So there's a lot of sort of crosswinds in this kind of basket of indicators. So I guess it's just nonsense right now. When you look at it, if you sort of squint your eyes and look at the big picture of everything combined, you can say, yeah, it's in a territory where it might be signaling a bear market possibility, but I don't know if you want to rely on that too much right now, one way or the other.
All right. As we're talking, Brett, hitting high, definitely afternoon session highs. This is going to be our best level in the Nasdaq since about 11 o'clock this morning. You got any thoughts on this? I'm looking around for any headlines. I haven't seen anything. Obviously, a little bit of squeeze action once we got through that 75.85. How are you treating this with your Nasdaq short? I'm not 100% sure where your stops are right now.
Back at entry, 76.30, and I kind of took this as a process of wanting to leave a piece to run. If you look at the last two sessions, it's a sideways range. We're bouncing back and forth inside of it. My short was well placed in that it was in a sideways smaller range, an opening range today that was above the highs of that larger range. So it had gotten back to an area that was resistance. It had poked out at the top of that range, and then the short itself was initially pushed into the money by a move back down into that range. And now we are a little bit above the midpoint of that range. It's always possible that we've got a headline catalyst brewing here. We might start to see that, something becomes more public that's being kind of passed around right now. But ultimately, we bounced down, we hit support. We do have plenty of people who were short this market, so it's not surprising to me to see back and forth in this range with a squeeze here and there. The question is, will we be able to get back above for instance, the overnight highs from Sunday night? Will we be able to get back above the ledge that we broke down through on Friday when the selling really accelerated? We'd have to get back up to there to stop me out. So I think I've got a really comfortable place for my stop, and I've already taken, a pretty good chunk of profits on it. So I'm just relaxed, just letting it do what it does. If we see this kind of move to recheck up to this area above 7,600 and, above 2880 in the S&P, and then we roll back over and get to the lows, it's a much better place than it was when it was at the lows before, because it's already gone through this process of making a lower high and squeezing out some shorts. So it's all part of the process of possibly moving back down to test the lows if we can see resistance step in somewhere in this area, maybe a little bit above here, and then roll back over.
Okay, so we took a look at the sentiment readings there, certainly a little bit more towards the pessimistic side, understandably so. Let's take a quick look at the options activity, and I think that we're going to see similar action where a little bit more of a turn on the pessimistic side, but not enough to really strike any sort of extreme levels. But over the past 3 weeks, the robo traders have spent at least 25% of their volume buying to open put options, while the largest traders have been spent, and that's the Lobo, spent at least 30% of the volume on puts, which is one of the highest levels we've seen, according to the data that I was looking at, since about 2000.
What was the initial stat? Sorry, the Robo?
The smallest of options traders, which I was to take as the Robo, spent at least 25% of the volume buying to open put options.
Yeah, buy to open put. So
Right.
Opening short positions in the market.
Correct.
So, and the Lobo?
And the Lobo spent at least 30% of their volume on puts.
Okay, so in each case we're talking about, that's not an extraordinary amount, though, is it? 25% means 75% was not doing that.
No, but I guess the combo of the two
was the highest amount of put buying?
From what I was seeing since 2000, that's only happened once before, which was in March of 2008.
That's interesting.
Yeah. So, and of course, that was about, 5 months or so, call it, before we got the big rollover. So,
yeah. It was around Bear Stearns, wasn't that?
Right. Yeah, that would have been right around Bear Stearns, exactly. So there was a lot of activity going on. I guess if you're looking for an equation, you could be talking about the president and his tweet about ordering U.S. companies to close shop in China. So, and it was noted that the S&P did rally 7% more over the next couple of months before rolling over. So this isn't necessarily calling a top, but I found that number to be pretty interesting. And then just looking at the ICE exchange here, options traders bought only 58 calls for every 100 puts, which was among one of the most extreme readings of put buying in the data's 12-year history. So that was certainly of interest. That was something that was sticking out to me. The only dates with less call buying, which triggered in 2014 and 2015. 2014, I believe that's when we had that big wipeout of a lot of the tech space, right?
When?
A lot of the smaller tech in 2014.
No, when?
2014.
2014. I don't remember a big wipeout in tech in 2014.
And,
I'll take your word for it.
In the smaller tech, I believe that was in 2014, right? And,
okay.
2015.
That's when we started. 2014 to me is synonymous with the gigantic run higher in the dollar and the beginning of the crash in crude oil.
Hey, real quick, Brett. 2015 would have been the crude oil crash, no?
Well, it started in 2014. It was in midpoint through 2014 is when the Fed shifted directions on liquidity. They began to close out?
Real quick, just while we have this going on, because we want to keep an eye out on this action, which we're seeing a little bit of squeeze. Supposedly, there was a rumor about a phone call. Now, this phone call was scheduled to take place, is from what I was seeing earlier. So, it is possible that I'd just be
Is it Xi and Trump talking? Is that what we're...
It was major principals were supposed to be involved in it. I don't think it was Xi and Trump. I think it was supposed to be Mnuchin and Liu He looking to set up a September meeting. So I was reading, it was a JP Morgan note that they did have this call set up. So I'd be cautious in either jumping in long or short here until we get a little bit more color. Because obviously we've got the squeeze on here. Now we're rolling over a little bit, and I'm sure this is... shorts trying to say that the phone call was fake. Of course, it very well could have been a fake phone call. Now, from my understanding, there was supposed to be something scheduled today. So that would have me a little bit of cautious that of just dismissing this as a headline.
Okay.
So back to the options activity here. And then we talk about the total and equity ratios on the CBOE. The small options traders, from what I was seeing, they're still buying too many calls, was one of the things that I was seeing at the CBOE in the commentary. So
it contradicts to some extent the other data points.
Exactly. But I do think that the overall takeaway that I would say, and in looking at the Lobo and Robo ratio that we look at on a weekly basis, Brett, I wasn't really seeing much movement in either one. Certainly a little bit more on the pessimistic side, but I would definitely say that we're seeing, similar with sentiment, a lot of the flow going more towards that protection and put side here.
Yeah, a bit. But one thing that I would like to spend just a moment on is sometimes this data can be difficult to perceive in terms of what it necessarily means for the markets. And one way that I try to think about it is I think of the market as sort of a stratigraphically layered composite of different participants, with each layer really being defined by different terms of risk tolerance, which is actually really about leverage. So like how, if you imagine short-term day traders who are trying to make a lot of money on little wiggles, you imagine really active investment funds and leveraged funds and really active swing traders, kind of being one level out in terms of how much leverage they're taking and what sort of movement would really burn them or make them. And one level out, maybe active market timers and stock pickers, and then you go another level out. You got 401k managers and pension funds and long-term portfolios. So you have this sort of stratigraphic layering of different risk levels. And a lot of this data, you get to extremes, but it's really sort of representative of one of those layers. And something that we've seen a little bit lately, and one of the reasons why I was looking to short this market, is the sense that you get to some short-term extremes in bearish sentiment, some panicky feeling, and then you get a bounce, but that bounce kind of underperforms what I'm looking for. And a lot of times, to me, that feels like, I start to conclude in a sort of tape composition model way of looking at the universe, that what's happening is you have some resetting and rebalancing among shorter-term players, maybe the first couple of those tranches, but longer-term money is starting to get on the offer. And they hadn't really been panicked, and now they're starting to go through the process of sliding from complacency toward fear and pessimism. So they kind of interact, these different layers. And I think that my read of what we've been seeing underneath the surface is a little bit of that, as at least a possibility, that we're seeing some of the money that's in the market that's been much longer term minded and hasn't really been shaken. Now, you could combat this argument by saying take a look at the bond flows. That a lot of that money has already been out. But I think that's a mistake. I think that there is still quite a bit of ownership of the stock market that is in longer-term portfolio managers, and it can still be adjusted down. And if we're starting to see extremes in bearish sentiment that then quickly reset to neutral, and the market during that same time of that resetting underperforms, it doesn't just give us a big giant V-bottom rip back to the upside. We start to see some resistance come into play, perhaps a little bit lower. We start to see some sideways ranges, and then we start to roll over again. That kind of process is the sort of thing that defines more protracted bearish trends. I don't know whether that's what we're going to see or not, but that's the sort of thing that I recognize from that kind of process where you get a lot of moments of extreme bear sentiment that quickly resets to neutral and then go back, but it's not super extreme bear sentiment. It's not the type of thing that we saw last December. It's just sort of like we've seen over the last few weeks, kind of moderately bearish lean to things. And we see a couple of indicators spike, but a bunch of them sort of stay neutral to slightly bearish. And you kind of wiggle in that space and then get back to neutral, wiggle back into that space and get back to neutral. And at the same time, the market starts to make lower lows because you're really moving through those kind of stratigraphic layers of risk exposure in the market as a different group starts to become nervous and starts to become, selling a seller in the market. So I would be. That's one of the things that I've started to see a little bit here as a character to the action, and one of the reasons why I was looking to short into a headline-driven bounce. And so far, I haven't really seen anything that suggests to me that perspective is wrong. And certainly seeing a little bit of this sort of internally contradictory options data removes from me the fact that I need to start worrying about that, especially when I see, again, the Robo and Lobo are really, they're pretty neutral right now. And this is data, collected across the last several weeks when we've seen a lot of this stuff really come to a head. So I'm willing to be short this market now, despite the fact that we see things like the SPY liquidity premium signal.
Okay, so we covered some of the sentiment. We covered some of the options data that's out there. There was a few things that I was going to throw at you. First, one of the things that I wanted to talk to you a little bit about, and we did mention it before, but I probably should have brought it up at the time, and that was administration uncertainty. This was one of the sentiment readings that I was taking a look at. This kind of goes back to why it's so tough for us to disentangle some of the comments that we need to make on trade policy and what that entails for the markets. But I shouted over to you earlier, Brett, and that was the Baker Bloom Davis reading, which is at one of its highest levels in 30 years. Now, this is basically encompasses all the any news-based economic policy uncertainty that's in any newspapers, TV shows, magazines, and anything under that category. And this had hit its highest level. We haven't seen it this high since Brexit, and it's certainly on the climb here. Some of the other times that it spiked up to the levels that we're seeing right now would be the tax hike plus spending cuts back in 2013, the debt ceiling back in 2012. The global financial crisis, of course, the Gulf War back in 2003, 9/11, the Asian financial crisis in 98, and the Gulf War again in 92. So it's at one of these extreme levels, and that just kind of goes back to the idea of why we need to discuss this. So I don't know if you got any thoughts on that, or if that's really breaking any new ground for you there.
No, I mean, I think that a lot of it stems from some of the hurdles that we have economically as well as some of the geopolitics that we're seeing. But obviously, I think you could guess that this is a time of dramatic uncertainty there. Just look at the business investment and spending.
Right. So, next topic that I wanted to break into you with is volatility breaking a trend. So, the average day over the past month in the S&P 500 is moved 1%, which is one of the widest that we've seen since the financial crisis. There's a lot of people that view such activity as something that could break a trend, and we've obviously been in a long upward trend. Just if we're taking a look at a monthly chart on anything pretty much. Do you see this activity as breaking that?
Breaking the trend of...
Breaking the upward trend. I mean, if we just take a look at the continuous in the S&P, just for argument's sake.
Oh, I see. Just the long-term market trend.
Yeah, we're looking at that on the monthly.
I think we have a larger risk of that at this point than we've had in a long time. Yeah. So, I mean, there's the sentiment data is a little bit difficult, and the politics are a little bit difficult to disentangle all of it. But if you want to look at a weekly chart, you can see if you sort of just kind of pan back and look very objectively, don't worry about anything that's going on, we have made something of a possible very large time frame wedge top. So that's something to keep in mind. If you want to look at a monthly chart or a weekly chart, you can see a big giant wedging pattern in basically any of the indices, where you get barely higher highs and gradually reducing width of the swings in between when they make. So you get kind of like a wedge shape in the major swings as you're making barely new highs. So that's typically a bearish pattern over longer time frames, and that's in play, and it kind of shows that each breakout is becoming subsequently weaker. And it leads to greater vulnerability. Now, when you look at things like the fund flows that we've talked about for a while, it's not like, if you saw this pattern in a market where there was a big speculative frenzy, there's a huge amount of money being poured in, particularly by retail investors, and everybody was ready to be hung out to dry, it would be much more worrying. So there is that idea that kind of tempers everything here when you look at long-term technicals, that you've got so much money that's already been kind of hedged out of the market or brought into undercover. And if you were to see something like a giant resolution to the trade war, then, it really paints a very different picture here. But if you just try to think, just get that out of your head and not worry about any of that stuff and just look at some of these big patterns, then there's a little bit of a concerning pattern now that would suggest a higher than typical risk. And it's another reason why I've been looking to short into a bounce where it's so clearly driven by headlines this week.
All right, and then the last question I'll throw at you, Brett, and we'll ask this for a blue chip trader, or we could call him Bert Ives trader, but silver and gold, Brett. There's a lot of questions about those two elements here. What's your thoughts on? We'll start off with gold, since you already have that trade. Well, you're all out of it now, I believe, right?
Oh yeah. And I got my piece. I got to my target. In fact, I got well past my target. I was looking for 1,500. I got 1,540.
But if I recall, when he closed out, you said that you would be stalking it possibly in the futures for another entry. Is that right?
Sure, that's correct.
So
now, after some kind of a flush out, because one of the reasons why it was also easy for me to get rid of is because we had a multi-year high in speculator long interest in that market already.
Right. So, obviously, we haven't gotten that pullback yet in gold. So, what's your thoughts here? What are the levels that, obviously, how it gets to the levels always plays a large part in your thinking, but what is it that you're looking for that would entice you back into this GLD trade?
Fear. I want to see fear. I don't care where it goes to. I want to see fear. I want to see there's a lot of money that's piled in, and you can see that in the CFTC data now. For gold in particular, there's a lot of media attention that it's gotten, and it's really started to break higher. And I feel like there's a lot of money that's really pushed in with maybe a relatively low risk tolerance if it starts to go the other way. There's a lot of money that's come in just recently and could be out of the money relatively quickly. And then, the second you get people to consider, oh, wait a minute, maybe this isn't a runaway breakout that I'm in, then you start to trigger, I think, a cascade of stops. And I'd like to see, before I would enter, I'd like to see that kind of cleaned out and maybe reset it back, dip back, and puke out underneath 1,500 again, maybe even 1,475, and really kind of dump it back out.
Fear, though. So when you're saying fear in owning gold? Yeah,
I want to see fear in the tape in gold. I want to see.
Okay,
I'm very experienced at watching gold, and it tends to have these big air pockets at certain points, and you can, when people are particularly piled into it, they lose sight of how damaging to your account it can be to be on the wrong side of gold without proper risk protection. Silver even more so, and when it really lets loose and starts to break some levels in an uptrend. Definitely in an uptrend, when you have this kind of momentum money in there, it can really spill out hard, and it will happen. In an hour, you'll see it go from 1540 to 1480. It's dramatic, 30, 40 points in a few minutes, because there's stops down there, and you just hit them, and the bottom just empties out. And I want to see something like that, and then buy into it. I think that the uptrend is relatively stable, but it needs to reset itself. It needs to clean itself out a bit. So I'm looking for something like that as an opportunity to buy again.
Well, let me ask, because with the silver, so gold I kind of get, obviously that's subject to some panic buying, especially in this uncertain environment. A lot of central bank easing, so that all makes sense. Silver, though, that's a little bit more economically tied. Now, I know that there's the gold-silver ratio that I don't know if that's playing in to the silver move, but what's your take on the silver market here, and why do you think it's going parabolic like this?
I think that silver always does the same thing to me. It's very predictable in a moment like this. Gold will rally, silver will wait. Then silver will start to play catch up, and then silver will overshoot.
Do you think it's simply on the people that are like buying based around that ratio?
Tied to gold. It's like it's tied to gold with a bungee cord. If you imagine two weights, you're standing in your garage, you're holding one dumbbell, a 15-pound dumbbell, and you got a bungee cord that attaches to a 2-pound dumbbell, and you quickly pick the 15-pound dumbbell up in the air and shoot it over top of your head. The other dumbbell is going to stay on the floor for a second longer, the bungee cord's going to stretch, and then it's going to snap back, and that smaller weight's going to shoot over top of the other weight. It's a physical metaphor, but it seems to hold relatively true for silver in relationship to gold. In most cases, it will lag at the beginning, then it will overshoot at the end. And this may mean that we are as we start to see more upside momentum in silver, this may be the overshooting process, and we start to then see, maybe a harbinger of a short-term correction in those markets.
Well, hopefully the traders don't get hit in the face with the weight. I don't see how this
this
analogy is going to work. But okay, no, that's a good take. All right, Brett. So there we go. I think we'll wrap it up here. We're going on just about an hour. We always like to try to keep this segment under an hour at a minimum, but there's a lot to talk about today. But I think if we want to wrap this all up in a nice tidy bow, I think it's pretty simple. I think it's just a growing uncertainty around the trade wars that's really starting to pan out in a lot of the options activity and making people a little bit more cautious. Now, we haven't really seen extreme levels across the board on the options activity, but certainly they're elevated more towards the pessimistic side. And the sentiment data, of course, same thing. I would say there's a few items out there that are hitting a little bit more on the extreme pessimistic side, but we haven't really seen that full bore concern that would lead to the big sell-off or invite us in for a buying opportunity yet. You think that's a pretty fair assessment?
I think that's a very fair assessment. And the one final note I'd like to make is I am now suddenly back in the money on the euro short. So we waited out of bounds, and it's actually come all the way back from where it was on Friday. So that's good.
Yeah, very nice. What's the next big event you're watching for the euro there? Is it Italy? Is it the ECB in September or what?
I just think that we're at this point where the conversation is going to start happening again about do we break up the euro? Because I think you're going to need fine, they can come out right now. And have you seen all the stuff out of like Weidman and others looking for, hey, we don't need to go with some big stimulus program right now. Have you seen that?
He's just completely asleep at the wheel, and I think that's going to backfire on him.
Well, but there's another part of it. I think it suggests behind the scenes that there's this kind of push of like, well, Germany's able to support its economy by being fiscally aggressive and supportive, but it's demanding that all of the smaller countries be austere as things get worse. And so it's this exact same drama again about can this system work as a whole on both sides of the cycle. Everything's, of course, fine. We don't get the break up the euro conversation when everything's going well, spreads are tight, economies are growing. But as soon as you start to get to the point where we are back in a stimulus-based regime, we are back in a situation where people are facing contractions, we're starting to see unemployment rates rise. As soon as you get there, you go right back to this conversation again, and I think you're going to again. Is the euro something that can continue to exist?
The most interesting aspect of that whole thing is I would argue that Germany's probably performing the worst.
Yeah, it is now, but it's just a message. Here's what we're not going to increase our austerity. I mean, obviously they've got a better balance sheet, but it's still politically divisive, and this is a political message.
It is,
especially with everything going on in Italy.
Well, and especially when I think it's pretty fair to argue that method failed in 2011, 2012 around the Brexit, right? I mean,
Absolutely fixed.
their banks have been in a steady decline. They've never truly recaptured any sort of
No.
semblance of growth. I would
You
argue
know
that
why? Because it doesn't work.
Ireland's I mean, it's tough to argue against that now. I mean, they've been through. Well, the German method certainly doesn't work, but have we really
No,
got?
you need they need their own currency to devalue.
Yeah,
That's
yeah,
it.
yeah.
It doesn't work. This doesn't work as an arrangement.
Yeah.
The secular and structural trend is bad since the euro came into existence. It doesn't work. Either you're going
Well,
to be the
not
United
not in
States and
this
Europe,
form.
or you're going to be separate countries.
Not in this form. That's for sure, right?
No, not in this one, right? You need a either like a central kind of everybody pays their taxes to the European Union and Brussels, and there's a fiscal channel, and there's fiscal management, and there's a EU bond, and the whole
And
bit that comes with
there definitely appears like there's zero appetite for that, especially with
zero.
rise of populists.
Rise of nationalism puts the death knell in it. So I think that there is grounds to look for a more dramatic version of this conversation, and it's why I wanted to be wide and small and short the euro.
Right. Um, yeah, that's a conversation for another time that we'll have to
Yes, it
save,
is.
but because we could spend an hour on that alone. But all right. Well, I think we got everything. You got any parting shots here, then, Brett?
No, that's it. I mean, I think that we've already seen pretty much all of that rally in the Nasdaq come back down. So
Um,
as I said, it's better. It's better to be at 75.50 after that rally than before it. So we're in a better position now on that short than we were before that nice little squeeze to shake out some of the short interest, and those shorts now have to short again, and to suck in some weak-handed longs who are now going to have to sell. So there's
yeah.
more ammunition to actually break the lower end of that range. May not happen today. I may get poked out of this piece, tomorrow. But so far, it's a good situation.
Right. And for the last 30 minutes of trade, we'll want to keep our eyes out on the headlines because,
Certainly,
the
it's a
markets and the
minefield.
bots are, yeah, it's a minefield and people are out there watching it. So, all right. Well, Brett, great stuff as per usual. Thanks so much for joining us here. And
Okay, guys.
for anybody that's out there, we will be posting this shortly to the site.
Okay, thanks a lot.
All right. I'll talk to you soon.